actually goes into your credit score anyway, and why do lenders care so much about it? Your credit score is actually made up of a few different components. It's made up of how much money you borrowed across everything that you borrowed. Are you paying your bills on time? And how much credit are you actually using? Those are all three big factors that make up your credit score. A lender is not going to give you a mortgage if you have a low credit score. You have to have a minimum credit score of over 650 to qualify for an insured mortgage, meaning you're putting less than 20% down as a down payment. Or if you want to do a refinance of your existing mortgage, you have to have a minimum credit score with a lot of lenders. So that utilization factor is really important. So what that means is lenders do not want to see you maxing out or using more than half of the credit allowed per trade line. So a credit card is a trade line, a line of credit is a trade line, a vehicle loan is a trade line. And anytime you use more than half of what is allowed on that card, it actually brings down your score. It's almost better to have 10 credit cards with very small balances than to have one credit card maxed out. Now, I'm not saying to go out and get a whole bunch of credit cards. I'm just saying if you're trying to increase your credit, a good way of doing that is by not carrying a high balance, making sure all your bills are on automatic withdrawal, and actually using credit. So use that credit card for everyday purchases like gas, groceries, and then immediately transfer the money over it. Hey, I'm Lara Rockefeller, and I help Canadians just like you with their debt and with getting into houses.